silver just hit $1,000. At least, that's the number now circulating among analysts who, until recently, refused to say it out loud. Something changed this week. Not a rumor, not a headline built for clicks. 3 separate events. One in the Middle East, one inside a Federal Reserve report, and one deep inside Chinese trading data, collided within 72 hours of each other. And when analysts overlaid them on the same timeline, the pattern was impossible to ignore. This is not a story about panic. It is a story about positioning. And by the end of this video, you will understand exactly why serious money moved first, while everyone else is still asking questions. Stay until the end, because Part 5 explains the one number that changes everything. Welcome back to Precious Metals Intelligence. If you're new here, this channel exists for one purpose: to translate complex economic signals into clear, actionable understanding, without hype, without noise, and without wasting your time. Before we begin, it would genuinely mean a great deal to know where in the world you're watching from tonight. Please share your city or country in the comments below. And if you find value in this kind of analysis, consider subscribing. It helps this channel continue producing the level of research this moment demands. For most of the past decade, analysts treated the idea of $1,000 silver as a fantasy. It was the kind of number that showed up in forum posts and late-night videos, dismissed by serious investors as noise. Silver, after all, had spent years trading in a narrow, forgettable range. It moved when gold moved, and it rarely made headlines on its own. But something changed in recent weeks, and the people who study markets for a living stopped laughing. 3 separate developments happened almost at the same time. On the surface, they looked unrelated. One involved rising tension in the Middle East, centered on Iran. Another involved a critical inflation report released in the United States. And the third involved a quiet shift happening inside China's physical metals market, far from the headlines that most people read. Individually, none of these events would be considered shocking. Geopolitical tension rises and falls. Inflation reports come out every month. China has been buying metal for years. But when analysts placed all 3 events on the same timeline, something became clear. They were not isolated. They were connected. And that connection is what this video is going to explain. To understand why this matters, it helps to understand what silver actually is. Most people think of silver as jewelry or coins or something used in electronics. That is true, but it is only half the story. Silver has always carried a second identity. It has served as money. Long before paper currency existed, silver was used to trade, to save, and to store value across generations. That history did not disappear. It simply went quiet. And history has a pattern of returning at the exact moment people stop paying attention to it. This is why silver behaves differently than most other assets during times of stress. It is not only a financial hedge. It is also a physical material needed for solar panels, batteries, medical equipment, and military technology. This dual identity means silver can be pulled higher for 2 very different reasons at the same time: fear in the financial system and real demand from industry. When both forces move together, the impact does not simply add up, it multiplies. That brings the discussion back to the 3 events mentioned earlier. Analysts who study long-term cycles say this kind of alignment is rare. It is not something that happens every year or even every decade. Most of the time, geopolitical risk, monetary policy, and physical demand move independently, canceling each other out. But every so often, they line up in the same direction, at the same time. When that happens, markets do not move slowly. They move suddenly, and often without warning to the general public. This is the part that deserves close attention. The people who manage large amounts of money, including institutions and even central banks, do not wait for public confirmation before they act. They study patterns quietly, they position early, and they rarely explain their reasoning until much later, if at all. By the time an average investor reads about a shift in the news, professional money has often already moved. This is not a conspiracy. It is simply how large capital behaves. It moves ahead of public understanding, not after it. That is exactly why this moment deserves attention now, rather than later. The tension involving Iran is not just a distant political story. It touches global shipping routes, energy prices, and investor confidence, all of which connect back to how people value hard assets like silver. At the same time, the inflation report released in the United States raises new questions about how much control the Federal Reserve truly has over prices. And in China, physical silver premiums have been rising in a way that historically has served as an early signal, long before Western markets catch up. None of these 3 events, on their own, would justify the kind of number mentioned in the title of this video. But together, they form what analysts call a confluence, a rare moment when separate forces reinforce each other instead of canceling each other out. Understanding each piece individually is the first step. In the next part, the geopolitical angle will be explored in detail, starting with what is actually happening around Iran and why it matters far more to the silver market than most people currently realize. Wars rarely begin with silver in mind. Nobody sits in a room discussing troop movements or sanctions and thinks about an industrial metal used in solar panels. Yet, time and again, throughout history, conflict in one part of the world has quietly reshaped the value of precious metals everywhere else. This is not a coincidence. It is a pattern that has repeated for generations, and it appears to be forming again right now, centered on rising tension involving Iran. To understand why this matters, it helps to think about what a region like this actually controls. Iran sits near some of the most important shipping routes on the planet, including narrow passages through which a large share of the world's oil supply travels every single day. When tension rises in that region, it does not stay contained to politics. It spreads into energy markets almost immediately. Oil prices become unstable. Shipping insurance becomes more expensive. Businesses that depend on predictable fuel costs begin adjusting their expectations. And investors, sensing instability, start looking for somewhere safer to place their money. This is where gold usually enters the conversation. Most people already understand that gold rises when fear rises. It has played that role for centuries, and investors trust it instinctively during uncertain times. But silver often gets overlooked in this exact moment, and that is a mistake worth correcting. Silver does not only respond to fear, it also responds to real physical demand. Unlike gold, which sits mostly in vaults and jewelry boxes, silver is consumed. It disappears into electronics, into solar panels, into military equipment, and into medical devices. Once used, most of that silver does not come back to the market. This means that when geopolitical tension rises, silver can be pulled in two directions at once. Investors buy it as a safe haven, the same way they buy gold. At the same time, industries that depend on silver for production continue needing it regardless of what is happening politically. Factories do not pause because of headlines. Supply chains still need to function. This overlap between financial fear and industrial necessity is part of what makes silver behave so differently once real pressure enters the system. It also helps to understand who moves first when tension like this appears. Ordinary investors usually react after they see prices already moving, or after a headline convinces them something serious is happening. Large institutions behave differently. Hedge funds, sovereign wealth funds, and yes, even central banks tend to study these situations quietly, long before the public becomes aware of them. They do not wait for confirmation. They analyze shipping data, energy contracts, currency flows, and metal demand long before ordinary investors are paying attention. By the time the average person hears about a crisis on the news, professional money has frequently already repositioned itself. This is not something hidden or secretive. It is simply how large capital has always operated. Big decisions require time, research, and quiet execution. Nobody managing billions of dollars wants to announce their strategy in advance. They move first, and explanations come later, if they come at all. This is precisely why unusual buying patterns in precious metals often appear before major news events become widely understood by the public. There's another layer worth mentioning here, one that connects directly to energy. Oil and precious metals have a long, tangled relationship. When oil becomes more expensive or less predictable, currencies tied to energy importing nations often weaken. A weaker currency makes hard assets like silver more attractive because people naturally look for something that cannot be printed or devalued by a central bank. This is not a new idea. It is one of the oldest ideas in economics, and it becomes relevant again every time global stability comes into question. So, while a headline about tension involving Iran may seem distant to someone simply trying to understand their own savings, the connection is closer than it appears. Energy markets, shipping routes, currency confidence, and industrial demand all link back to the same conversation about hard assets and their role during uncertain times. This geopolitical pressure is only the first piece of the puzzle, however. The second piece comes from much closer to home, inside a report that most people glance at for only a few seconds before moving on. That report is the latest CPI inflation data, and what it reveals is far more significant than the number on the surface suggests. That is where the discussion turns next. Every month, a single report is released that most people barely notice. It appears for a moment on financial news channels, gets mentioned briefly in the morning, and then disappears from public conversation by lunchtime. That report is the Consumer Price Index, commonly known as CPI. It is supposed to measure how much prices are rising for ordinary goods like food, housing, and fuel. But the latest reading has caught the attention of analysts for reasons that go far beyond the headline number itself. To understand why this matters, it helps to step back and ask a simple question. What does inflation actually do to money? At its core, inflation means that the same amount of currency buys less over time. A person's savings do not grow weaker on their own. They are weakened by the slow erosion of purchasing power year after year, often so gradually that it becomes difficult to notice until the damage has already been done. This is why inflation is sometimes called a hidden tax. Nobody votes for it. Nobody signs an agreement to accept it. It simply happens, quietly in the background of everyday life. The latest CPI report gave the Federal Reserve a difficult choice. If inflation appears to be cooling, the Federal Reserve gains room to hold interest rates steady or even lower them in the future. Lower interest rates are often seen as good news for stocks and borrowing costs. But there is a second side to this story that receives far less attention. When interest rates fall, while real inflation remains elevated underneath the surface, the result is something economists call negative real interest rates. In simple terms, this means the return investors earn from holding cash or bonds fails to keep pace with the true cost of living. Money sitting in a bank account quietly loses value, even while the account balance stays exactly the same. This is precisely the environment in which precious metals have historically performed best. Gold and silver do not pay interest, they do not generate dividends. For decades, this was used as an argument against holding them. But that argument only holds up when interest rates are meaningfully positive after accounting for inflation. Once real interest rates turn negative, the equation changes completely. Holding cash begins to feel like a slow, guaranteed loss, while holding a hard asset that cannot be printed or diluted becomes a rational form of protection rather than a speculative bet. There is another layer to this story that deserves careful attention. Some economists and policymakers have begun questioning whether traditional inflation measurements fully capture what people actually experience in daily life. Certain officials have suggested that standard inflation metrics may overstate short-term price shocks, and have proposed using adjusted calculations that filter out volatile swings. On paper, this sounds like a reasonable technical adjustment. In practice, it raises an uncomfortable question. If the method used to measure inflation keeps changing, how can anyone be certain the true picture is being reported accurately? This is not a new concern. Throughout history, governments facing rising debt levels have often found ways to adjust how inflation is measured, particularly during periods when acknowledging the full scale of the problem would create political or economic difficulty. This does not require any hidden conspiracy. It simply reflects a natural incentive. A government carrying trillions of dollars in debt benefits when inflation is allowed to quietly reduce the real value of that debt over time. Savers and everyday workers, unfortunately, sit on the opposite side of that same equation. This is precisely why the CPI report connects so directly to the earlier discussion involving Iran and global instability. Geopolitical tension creates fear and urgency in the short term. Inflation data and Federal Reserve policy create a slower, quieter form of pressure that builds gradually beneath the surface of everyday financial life. Individually, each force might be manageable. Together, they begin to explain why serious analysts are reconsidering assets they once viewed as outdated or unnecessary. Silver, once again, sits directly at the center of this pressure. It offers protection against currency weakness in the same way gold does, while also carrying real industrial demand that does not disappear simply because interest rates change. As the domestic inflation picture becomes harder to interpret with full confidence, attention naturally shifts overseas to a country that has been making its own quiet moves in the physical silver market for quite some time. That story, involving China, is where the discussion turns next. While much of the world remains focused on interest rates and political headlines, a quieter story has been unfolding inside China, one that receives far less attention but may carry even greater long-term significance. For years, China has been steadily increasing its appetite for hard assets, and recent data suggests that silver has become an important part of that pattern. To understand why, it helps to look at the choices available to an ordinary person living in China. In the United States and much of the West, people have access to a wide range of ways to protect their savings. They can invest in stocks, bonds, real estate, retirement accounts, and countless other financial products. In China, those options are far more limited. Capital controls make it difficult to move large amounts of money outside the country. The real estate market, once considered one of the safest places to store wealth, has struggled badly in recent years, leaving many families uncertain about where to turn next. The domestic currency, the yuan, is not something most citizens fully trust as a long-term store of value either. This leaves a much smaller set of realistic options, and gold and silver sit near the top of that list. Unlike many Western investors, ordinary Chinese citizens have a long cultural relationship with precious metals. Silver and gold are not seen as unusual or old-fashioned. They are seen as practical, trusted forms of savings passed down through generations. When uncertainty rises, this cultural comfort with hard assets tends to translate directly into buying activity. Recent data coming out of China's physical silver market supports this idea. Prices for physical silver traded inside China have been running noticeably higher than prices on international paper markets. This gap matters more than it might first appear. Most of the silver traded around the world exists only on paper, in the form of contracts and financial instruments that rarely involve any actual metal-changing hands. China's physical market works differently. It reflects real buyers seeking real metal, not speculative trading. When physical premiums rise in China while paper prices elsewhere remain calm, it often signals that genuine demand is building faster than the official numbers reveal. This is not a new pattern. In previous cycles, shifts inside Chinese physical markets have often appeared before major moves became visible in Western financial media. By the time most investors in the United States or Europe begin paying attention, the underlying shift has frequently been building quietly for months. This is part of why analysts pay close attention to what is happening in Shanghai, even when it receives almost no coverage on mainstream Western news channels. There is also a strategic dimension to this story that goes beyond individual savers. China's central bank and various state-linked institutions have been increasing their gold reserves for an extended period, reducing reliance on foreign currency holdings, particularly the US dollar. While silver does not receive the same level of attention from central banks, it benefits from a similar underlying motivation: reducing dependence on any single currency and increasing exposure to assets that cannot be created or devalued through printing reflects a broader shift in how major economies are choosing to protect themselves. This is where the earlier parts of this story begin to connect. Tension involving Iran creates immediate pressure tied to fear and energy markets. Inflation data and Federal Reserve policy create a slower, quieter pressure tied to currency confidence at home. And now, China's physical buying behavior adds a third dimension, one rooted in structural long-term positioning rather than short-term reaction. Individually, each of these forces might be dismissed as unrelated noise. Geopolitical tension comes and goes. Inflation reports arrive every month. China has been buying metals for years. But when all three forces align at the same time, history suggests the result is rarely gradual. It tends to arrive quickly and often without warning to those who were not paying attention. That convergence, and what it may mean for where silver goes from here, is exactly what the final part of this story will address.